Australia's official cash rate is now down to 0.75%, a quarter of the emergency rate we had in the GFC of 3%. So where to now for housing, for stock markets and the broader economy? The cut in the cash rate to another record low was widely expected and comes in the midst of no progress in trade negotiations, more evidence of a weakening manufacturing sector around the world, and further falls locally in consumer and business sentiment. Overseas, the German economy, the fourth largest in the world, is teetering on recession, caught between trade wars with the US on cars and with the UK on Brexit. But for Australia, it's still our largest trading partners in China and Japan that are the key to how trade conflict will impact our economy. Japan's economy is suffering from the trade tensions even more than expected, based on yesterday's Tankan business survey, and China's deceleration is well documented. As the chart shows, the official GDP rate is down to 6.2%, and unofficial proxy estimates are closer to 5%. But the Chinese administration have monetary and fiscal ammunition up their sleeves, unlike much of the rest of the world, so expect more stimulus measures from China in the months ahead. Here, the RBA have come to the party with another rate cut. However, as they have noted, monetary policy will need other measures to be effective. The federal budget is now effectively balanced and set for a healthy surplus this financial year. So, for wages growth to pick up, we may need further fiscal stimulus rather than just RBA rate cuts. The surplus comes at a cost. The one thing that rate cuts have delivered quickly is a return to rising housing prices, with an impressive 1.1% rise in the capital cities index in September, and Sydney and Melbourne up 1.4% over the month, although other capitals and regional prices were more stable. But overall, we continue to forecast a soft landing for housing. Our other core forecasts this year have been falling global interest rates amid the trade wars, and also a falling Australian dollar, mainly driven by a strong US dollar and a slowing Chinese economy. And more recently, a liquidity squeeze in the States has added to this demand for US dollars. So the Aussie dollar decline probably has another down leg left in it prior to the US economy's slowdown next year starting to turn the tide. Lower interest rates will keep encouraging investors into other asset classes beyond cash and bonds, especially into property and stocks. So, with more rate cuts expected next year here and around the world, and an era of ultra-low rates implied by bond yields, stocks are back in demand here and overseas, with our ASX 200 index and the US indices back near record highs, for now. Although some Asian markets are doing it tougher due to geopolitical tensions. As for our broader economy, GDP growth slowed to 1.4% last quarter as expected, but that may be the low ebb prior to the rate cuts, tax cuts, and the lower Aussie dollar coming to the rescue. Other advanced economies overseas may not have as much going for them. And that's the market update from Leveraged.